The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Oh, happy December. Have you all opened your advent calendars? Especially the ones with little chocolates in it. Good morning to you. I hope you're all well. You are watching Squawk Box Europe with Juliana Tattlebaum. I'm here to assist us, Steve Sedgwick. These are your headlines. So far, no signs of the Santa rallying continue. Slow to take off, with European futures pointing lower, whilst the Nasdaq is cooled down 1% as risk-off sentiment just a little bit creeping back into equity markets.
Meantime, UK Chancellor Rachel Reeves denies claims she misled the public over the state of the country's finances ahead of last week's budget, with opposition lawmakers calling for an investigation. And Bitcoin slumps to start December, continuing a weeks-long sell-off that saw the cryptocurrency shed more than 15% of its value last month.
Morning. How are you?
Morning. Nice to see you. Nice to be back.
And nice. Yeah, we're both back.
Yeah.
We both missed a week of furore and speculations and shenanigans and market vicissitudes of fortune. Do you know what? It's the same story. Apart from the fact the markets rallied health for leather last week on the back of what? What were they falling aggressively for the previous couple of weeks? And what were they rallying really hard for there? And the fact of the matter is, nothing has changed. Nothing has changed. We still have the same questions about AI spend. We still have the same questions about the strength of the US consumer. We still have the same questions about whether markets are broadly overvalued, about whether the Fed is going to cut, which apparently is 87.4% certain that we will on the 9th and 10th of December as well. Nothing changed apart from sentiment and momentum. And they are powerful forces.
Yeah, when I was looking back this morning at what happened last week, I had to double check that U.S. markets had in fact rallied as much as I was seeing. I said, is that really true? Did that really happen? One thing obviously we have to bear in mind is that it was a holiday shortened week in the U.S. Liquidity much lower than usual with Thanksgiving on Thursday and then the shortened trading day on Friday. So I would just argue that it's a little premature to read too much into the rally, and we'll have to see what happens over the next couple of weeks.
But by the same logic, it would have only taken a small event if we're suffering on liquidity to have sent it down quite aggressively as well, and it didn't. Although I noticed this morning, Bitcoin down 5.6%. I haven't got a clue why. I presume someone smarty pants out there will say it's because of some forced liquidation, it's because of so-and-so. But when an asset class can move so aggressively, and I haven't seen any decent copy, and I'm going to say this, on CNBC, on the FT, on Reuters, on Bloomberg, on every one of those major market sources out there, I've seen no one coming up with a conclusive idea of why a major asset is down 6%. That, for me, is the problem with crypto. The fact that random events can move so aggressively and no one's got a clue why.
And it's incredibly hard to value, and there's no consensus over how you value Bitcoin at this point. I think, fortunately for us, we've got a great guest on crypto who's also a Fed expert, and I think that's a great, set of accolades to have behind your name. Ben Amon's coming on in the 9 hours.
I do wonder if that guest will be saying crypto is a great purchase. Most experts in crypto tell me it is.
I think, fortunately, fortunately for us,
Michael Saylor tells me it's a great opportunity.
Well, so you got to be careful who you ask, right? I mean, I think that Ben is a great guest.
Someone's coming on CNBC to sell a product? I don't believe that.
I think we'll hopefully get a little bit more insight into how Bitcoin's correlated with some of the other key asset classes, because it is a key debate here whether Bitcoin can serve as a leading indicator right now. Well, if it is a leading indicator, we are in store for a downbeat start to trade this week. That's what we're looking at here in terms of European futures. We've got a red start indicated when you look across the different regions this morning. The CAC 40, the DAX looking to pull back about 0.4% apiece, leading the losses. Now, in terms of the month of November, here's a look for you at how European markets fared over the period. You can see, obviously, a lot of volatility here. Nothing compared to the volatility that we saw stateside, but still swings nevertheless. Ultimately, for the month of November, we did see gains in Europe outside of Germany, with the Xetra DAX ending about 0.5% lower for the month. Now, in terms of U.S. markets, we mentioned the rally last week. Here's where things closed up on Friday, bearing in mind, of course, it was a shortened trading day after the Thanksgiving holiday on Thursday, but all three of the majors did end higher. For the month of November overall, here's a look for you at how the period went for Wall Street. You, of course, saw a major pullback intra-month, and then, as we were just discussing, quite a rally last week. The S&P, the Dow, and the Nasdaq gaining sharply over the course of the week. Will those gains hold? Of course, that remains to be seen. In terms of U.S. futures, here's your early look at how the Wall Street session is poised to open. There's a look for you, at U.S. tech in November, and there you have on your screens U.S. futures. Right now, we are looking at a pullback across the U.S. market. Dorian Correll joins us now, head of multi-asset income at Schroders. Dorian, it's great to have you this morning. Thank you for joining us.
For inviting me.
Let me just kick off with your take on the investment landscape right now, how you see it, how you would describe it. What do you think in terms of what you should be doing with your money here?
Well, I heard you talking about crypto, and I'm not really going to give you a view on that. You've got an expert coming later on. But I think, when you look at November, you see much ado about nothing, really. You had a month of two halves with the market starting to relax a little bit when you saw the probability of rate cuts. I think you said it was 87.4%, something incredibly precise like that in December.
87.4. They're amazing, aren't they, markets? They're so precise when they need to be.
So it seems to be that gave a little bit of a relief to the markets, especially the tech sector. And when we look at Europe, we saw the Spanish markets doing quite well, banks doing quite well. But it was a bit of a mixed picture. I think thinking about Europe, you've got the German budget that looks like it's coming through now. You've got the Swiss referendum that's vaguely favourable. So it's not just about the Fed, but we do believe that the composition of the Fed's going to be key next year. And it's really that we're expecting Donald Trump to give an announcement coming up. And that's probably going to trump, if you excuse the expression, whether it's 25 bips in December ahead of payrolls. We're in a bit of a fog there. That's
a really important and interesting point, I think. Over the weekend, a lot of speculation now that Kevin Hassett will emerge as the choice here. Obviously, we don't have any confirmation of that. President Trump said he's decided on his pick. Kevin Hassett said, I'm not going to confirm anything. But in terms of the market here, how much does it matter what happens in December, in January, if we are looking at someone like Kevin Hassett coming in, where it seems pretty consensus now to believe that he's going to set interest rates on a lower path should he take the position?
I think that's the thing. It's much more about 2026 than the next few weeks. We've got the Fed, we've got payrolls. It's a very crowded calendar. But if you look at the way the Fed's looking next year, definitely it's looking the front end's going to be cut 3-4 times. That's what's priced in. And then you could have real rates at about zero by, say, September next year. So, that's what's driving the market. It's very dovish. It supports credit as well as equities. Credit spreads are very tight as we speak now. But, it's giving a shot in the arm to animal spirits. We know whether it works today or over the next few days is neither here nor there. But looking into 2026, it is fairly bullish. But the implications longer term, the structural implications are the ones that we're focused on at Schroders. And there we are a little bit worried about the inflationary impacts of tariffs, of fiscal stimulus, of deregulation, and, perhaps a very dovish Fed, adding to the picture.
I was listening to the Financial Times driving in this morning, and one of the articles I was listening to was I think it's a West Virginia gentleman whose healthcare costs, because of the ending of Obama era tax credits, tax cuts, or credits on that, his insurance is going to go up from something in the region of $400 per month to nearly $2,000 per month. Now, if that's being replicated across millions of Americans, plus rental costs remain incredibly high, plus food costs remain incredibly high, plus all kinds of other costs remain incredibly high, what difference is a couple of interest rate cuts going to make to the lives of those people? i.e., I'm really beginning to be very concerned about the US consumer.
Yeah, I think you can look at it in two different ways here. So you've got the midterms coming up in November, and obviously if the average consumer is feeling the inflationary effects that you're talking about, that could have quite an impact there. And you'll probably see stimulus coming through from the administration to kind of counter that. So you've got a deficit of 7%, but Trump is already talking about adding stimulus to the mix. So on the inflationary side, we do think it's a major concern for the consumer, but at the bottom end, the bottom decile, the bottom quartile. So it is a K-shaped economy. It's a cliche.
For sure, Dorian. But the K, let's say the 0.1, or let's even say 1% of Americans are doing incredibly well out of this. The market rally, and indeed are incredibly wealthy, and Trump tax cuts are working very well for them. The K, the bottom leg, represents far more Americans, represents 50, 60, 70, 80% of Americans plus who are struggling at the moment or finding it far more difficult. You should look at the data on food banks in the US. It's just gone through the roof as well. So my point is, the voters, if they are damning towards Trump, does that make him lame duck for 2 years?
That would be a very big call. That we'll wait to see how the Democrats line up in the midterms and so on. But I think the other point is that the US economy is not very rate sensitive. 80% of the borrowing goes through capital markets, and spreads are very tight. Private credit, I think you had someone on earlier on, that looks pretty tight as well. So conditions are very loose, and whether you cut by 1, 2, 3 or 4 times would make a big difference in Europe. In the US, not so sure. So the question is, will inflation stay at around 3%? And if rates go down to that levels, that's an incredibly sort of dovish picture for financial markets. What it means for the consumer, for Main Street, is a very different matter, and will have political implications as well.
In terms of what's going to drive markets in 2026, it sounds like assuming the Fed does become more dovish, that's going to trump everything else. But when you look back at the last couple of months, what drove the market concern seemed to be AI valuations. Yes. When it comes to the AI trade, how legitimate do you think concerns are around depreciation, around circularity?
Yeah, I mean, this is a concern we have, and we also have concerns around concentration, the starting point for the US market. So you have, 40% of the S&P, give or take, with mega cap tech, and then you have 2/3 of the MSCI world taken up by the US. So heavy concentration to start with. But when we look at the circularity problem, I mean, that's really about debt and the amount of debt that's going to be borrowed in the next year. And when we look at US IG markets trading around 82, 83 bips, I think it is, that doesn't look particularly healthy. You've got an M&A cycle potentially, you've got leverage coming in, and you can see through mega cap tech, should you heed the oracle, for example, about the way the CDS is moving and the equity price, there's an awful lot going on. And I think, what we're seeing is a change in the business models of the hyperscalers, of the mega cap tech names, moving from asset light to asset heavy. Now, we're not saying it's not going to work. We're not saying it's not going to come through in the next few years. But we are saying, should you pay such a high multiple with such high growth expectations baked in, which are funded from companies that are still trying to work out where the money's going to come from? And obviously that's going to come from the debt markets, particularly the private debt markets, which will be very interesting next year, we think.
Very simple question for me. I think we're getting close to the end of this interview, Dorian. Where should our viewers be putting their money? Where are you advising your clients to go at the moment? Yeah,
we're optimistic as well. So, I mean, if you look broadly, you look at Europe. Europe looks like a beacon of stability. 2% rates, 2% inflation, give or take. Yeah. The potential even for rates to go slightly up next year. You look at Asia. You asked about the AI trade. The picks and shovels are much cheaper in Asia, including a little bit in Japan as well. And finally, I would just highlight an asset class that people don't talk about enough in our view. It's convertible bonds, done very well this year, up about 15%. But we think that's like an asymmetric AI story. A very high risk return, very high components of the supply chain in AI, but you get a lot of upside with not much downside. So we think, you've got to look elsewhere. You've got to broaden out by asset class, broaden out by region as well.
Very nice. Thank you very much indeed. I suppose the key question is, have you opened your advent calendar this morning?
We actually cheated. We took the CIO's one last week and demolished it, including the 24th.
I love demolishing it before December even starts.
I love that, the fact that even at your elevated level at Schroders, you still have a sense of mischief with the CIO's. Was there chocolate in it?
There was a big dairy milk. Yeah, so
I love it. I love it. That's exactly how it should be. You should demolish the CIO's advent calendar as well. Okay. Brilliant. Dorian, superb. Love it. Apparently, we last chatted about 20 years ago.
Well, yeah, we did. I was looking slightly better at those days.
I'll see you in 2045.
Okay,
or maybe we don't leave it that long. Nice to see you. Dorian Carell, who is head of multi-asset income at Schroders. Thank you, sir. President Trump says he has made his choice on who should lead the Federal Reserve after the current chair, Jerome Powell, steps down, and will make the announcement soon. White House National Economic Council Director Kevin Hassett is seen as a likely choice. Speaking to CBS over the weekend, he declined to say whether he considered himself a frontrunner. Fed Governors Christopher Waller and Michelle Bowman are also reportedly in the running. Well, the Fed's policy of quantitative tightening officially ends today. It comes after the central bank began slowing down the pace of QT earlier this year. The move will allow the Fed to return to the bond market as a buyer, which is expected to push Treasury yields down further. US online spending surged on Black Friday, largely driven by AI-powered shopping tools, helping customers find deals. Online sales hit $11.8 billion, up more than 9% on last year, according to data from Adobe Analytics. Did you buy anything?
I did, but it was a pretty underwhelming purchase.
are you going to share with our viewers what you bought?
I can share. It's really, I have to say, underwhelming. I bought a baby monitor on sale, to watch the baby sleep. But I have to say, I thought that was going to be the lamest purchase in the office. And already, 2 hours into being here, one of our dear colleagues bought a vacuum cleaner. So I think she actually takes the cake. What did you buy? Or maybe you took the cake. Did you buy the most boring Black
You know
Friday?
the kind of stuff I buy. Lots of that.
Can I have one guess?
Yeah.
Did you buy another pair of trainers?
We've got to read on. Sorry. Was it? Yeah, we've got to move on.
How did I know? Coming up on the show, UK Finance Minister Rachel Reeves comes under further pressure following her budget amid accusations she misled the public. Plus, President Zelensky's closest advisor resigns after a corruption raid as more peace talks take place. And we'll discuss debt, the US, the UK, and more with IAF CEO Tim Adams. That conversation coming up at 8:30 London time.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's Miss Jo Malone, CBE.
I started that first business of skincare. That's when I knew that I was in charge of my own life. And that's when the entrepreneur really, although I didn't know what the word entrepreneur meant, that's when the entrepreneur really took hold.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this. Welcome back. UK Chancellor of the Exchequer Rachel Reeves has denied lying amid accusations she misled the public over the state of the country's finances in the run-up to the budget. This after the Office for Budget Responsibility said it had told Reeves on October 31st that increases in real wages and inflation had offset the impact of its 30 basis point downgrade to productivity growth, and that she could expect to have more than £4 billion in fiscal headroom. Now, that is 5 days before Reeves held an emergency press conference laying the ground for a hike to income tax in the budget, a policy which the government reportedly U-turned on just days later. Now, at the time, Bloomberg reported that the U-turn was down to improved forecasts, but the OBR has said any changes from its £4.2 billion figure were entirely the result of government policy. In other words, all else being equal, that forecast would not have changed. Opposition leader Kemi Badenoch called on Reeves to resign and said the Shadow Chancellor Mel Reid, beg your pardon, it's Mel Stride, has written to the Financial Conduct Authority over her decision not to disclose the fiscal headroom. Reform UK leader Nigel Farage has written to the Prime Minister's ethics advisor requesting an investigation into what he called potentially serious breaches of the ministerial code. CNBC has reached out to the Treasury for comment. Reeves addressed the issue on Sunday.
In the spring, I had headroom of £9.9 billion. The OBR numbers show that it moved around, but in their final pre-measures forecast, it was £4.2 billion. I clearly could not deliver a budget with just £4.2 billion of headroom.
I'm asking you to address this question directly.
Yes.
On November the 10th, you told the BBC, sticking to your election promise not to put taxes up would require deep cuts in spending on long-term projects. We know now you'd been told you had an extra £4 billion to play with. It wasn't true to say that, was it? Was it a lie?
I didn't have an extra £4 billion to play with. There was a downgrade in the headroom from £9.9 billion to £4.2 billion. But I was very clear in that speech on the 4th of November. I didn't want to have less headroom. I wanted to have more headroom. And the context of the budget, the biggest thing that changed was a downgrade in the productivity expectation going forward, which took £16 billion. Without that downgrade, that £4 billion would have actually been £20 billion. So I had to ask people to contribute more.
You can't move in the United Kingdom for conversations about the future of Rachel Reeves and the future of Sir Keir Starmer and what she did say and what she didn't say. I want to take a slightly different tack on this one as well. Of course I care about the budget. Of course I care about politicians being held to account. But in terms of these assets just there, this is what I really care about for you, the viewer, in many ways. And the fact of the matter is the pound has been steady throughout the whole budget furore of the last week or so. The FTSE has been steady. In fact, it's been better than steady. It's rallied over the whole period of this furore as well. Gilts have been solid. So gilts, the pound, and the UK shares have all been pretty steady as well. Let me just ask everyone out there a question. You may not like the government of the day. Goodness knows it's hard to like any government of the day, whoever they are, whatever political stripes they have as well, given some of the decisions they've made over the last few years. But the fact of the matter is, think about the counterfactual. Think about what will be in place for Great Britain, for the gilts there, for the pound, for equities, if we get a more left-wing Chancellor of the Exchequer and a more left-wing Prime Minister that doesn't really care so much about the markets, that doesn't care about fiscal responsibility, that wants more welfare and less access for the private markets to go and proliferate in the United Kingdom. All I'm saying is, look at the devil you know, rather than potentially saying, oh, they lied about this as well. Tory chancellors, as well as Labour chancellors, have said all kinds of things over the years, which I'm sure, if you held them to the mirror and you held them to the light, didn't hold up to scrutiny.
Well, I think in terms of holding up, when you look at the coverage over the last few days and what Rachel Reeves has been pressed on, breaking, misleading the public and breaking ultimately the essence of the manifesto pledges that the Labour Party made.
But that's not the last few days. That was last budget. That was a year ago.
Yeah, well, I guess now we have the confirmation from Thursday around freezing these tax thresholds and what that ultimately means. I mean, you look through all the analyst commentary, they say this is going to be the net effect of these tax hikes, because it's basically what it is. They're raising taxes, even though they're not actually raising the rate. They've sort of gotten around and says, we didn't break any promises here. We have not raised rates, but ultimately they are raising taxes by freezing these income thresholds. So I think a lot of the media coverage for the general public has been focused on that. But I guess when it comes to these measures, the other question is it actually going to be possible for them to implement these? Because a lot of them don't kick in. A lot of the measures that they've announced don't kick in for another few years. A lot of time between now and then.
I honestly feel most of this round now is about semantics. What I really care about is the fact that governments are so dumb, and I'm going to say governments, both Labour and Conservative, there you go, I'm apolitical, are so dumb that you want the young aspirational people in the United Kingdom to have to pay between £100,000 and £125,000, which doesn't make you rich, by the way. It makes you moderately wealthy compared to a lot of people as well. But it does not make you rich considering the amount of cost of living. I don't care what anyone says. That actually, if you have £100,000 to £125,000 of a single income, you pay over 60% tax. That is dumb from the Tories, and it is dumb from Labour, and it is a disincentive for young people or anyone in this world to go forth and try and earn more money as well. That is what I get really annoyed about. Not semantics over whether she had 9 billion wiggle room or 4 billion wiggle room as well. Quite frankly, that is the problem.
It's hard to disagree. When you look at the problem, one of the big problems here in the UK is growth. Where is the growth going to come from? Where is the productivity going to come from? And if you are creating an environment that disincentivizes investment from the contingent you just described, but also when you look at the higher rungs of the income ladder with the increased taxes on dividends, property, savings, all of this is just a disincentive to come here. So if you say you're a government that's all about the growth agenda, how can you justify that these measures are going to be pro-growth?
I would like Laura Kuenssberg or whoever's holding the feet to the fire for Rachel Reeves to say, how many more jobs were created, Rachel Reeves? How much growth was created by your increases to national insurance a year ago? And I would imagine it's almost impossible for the Chancellor to answer one job was created. In fact, ask the same question from the other side. How many jobs were lost because employers thought, I just can't afford to increase my workforce because the employment costs have gone through the roof. I can't afford to hire young people because the minimum wage has gone through the roof as well. If you tax companies too highly, they will not take on more employees. That is damning for any politician.
Yeah, absolutely. So is there, what is the probability that the UK ends up a failed state in?
Well, I don't. That's a long way away.
It is a long way away.
That's
but it's
a long
something
way.
that people are talking
Failed
about.
state is quite a way away.
I think it's obviously a sensational thing to say. Fair enough. But if this is the path that the UK government is going down, it's certainly the language that certain people are using to describe the situation here.
Yeah, but you've got to be careful when you're reading the Telegraph.
Fair enough. It was a sensational thing to say. I think it's more, if you are considering the UK on a 10-year view, does this change things? Do you look at other places?
I don't believe we're turning into a failed state, but I do believe politicians of both stripes have ignominiously failed to garner the extraordinary opportunities that are here. And again, if you're creating disincentives for private sector companies to hire people as well, then I agree with you that actually there are some big problems ahead. Not quite sure about failed state. I've got to be honest, that's a couple of steps I'm not willing to go just yet.